Now, I'm starting with a daily chart of the S&P 500, and I want to talk about the concept of correcting through price versus correcting through time. After an index or a stock makes a move, it's normal to see a correction. And in the example, let's say with a stock, if a stock goes from 40 to 50, and then as a normal pullback to, let's say, 44 or 45, that would be an example of correcting through price, which I'm sure you understand. Now, an example of correcting through time would be if that same stock went from 40 to 50 and just went sideways and barely corrected and held up in a tight range between, let's say, 48 or 50. That would be an example of correcting through time. And I find that to be more powerful because that shows that after a move, there's barely any sellers and it shows underlying strength. Now, how this applies to the current market is we had this pretty powerful move from 39, just to review, at the end of January, we had this GameStop situation, Wall Street bets, where a lot of people were fearing hedge funds might have to delever, sell some long positions to cover losses, maybe to meet redemptions. I digress. And as we know, the market tends to fool the majority. So when a lot of fear came into the market found support around this red line here, the 50-day moving average. And we had this strong move from roughly 3,700 to 3,900 in the S&P 500. And this is where I say in my videos, it would be nice to go sideways. I always say the market really doesn't care what I want, but why I say that is because going sideways, number one, is easier for market participants to deal with when there's very little price movement or any sort of major corrections. But more importantly, number two is it shows underlying strength. Again, when a stock or an index makes a decent move and barely gives anything back, it shows strength and that there's minimal sellers. And I even tweeted out after this move, we closed 39.15, 39.11, 39.10, 39.17, 4 straight closes of roughly sideways movement that shows strength beneath the surface. Now, when you look at a 5-minute chart, we also had some shakeouts intraday. On Wednesday, February 10th, we had this sort of hour or two sell program. Same thing on Thursday, February 11th. I love these shakeouts intraday because they shake out the weak shareholders. They create a little bit of doubt. Some people might say, well, I don't like this because it's too volatile for me. And that's why I'm stressing out. I'm stressing the point, no matter what your time frame is, get a strong entry point and just accept and deal with some of this volatility. That way, by getting a strong entry point, you have a profit and you're sitting at a cushion and you can deal with some of this movement. Why I like these shakeouts is because a lot of times before a stock or a market makes a move, we tend to see these shakeouts to shake out the weak hands. Now, later in this video, I'm going to go over through several stock examples that have done that, but I want to show you a market example really quick. This is a daily chart of the S&P in 2016 around that Brexit example. So for those who don't remember, we had this sideways movement for about a year between middle of 2015 until middle of 2016. Beneath the surface was kind of a bear market action beneath the surface. Again, I digress. But right before the market took off, we had this Brexit situation where we had this quick shakeout. The market dropped out about 6 or 7% to shake out the weak hands, create some doubt, and then we came right back and took off. Then once again, after digesting, we had this quick shakeout right before the presidential election in November of 2016 to have these quick shakeouts before we went on to strong gains later that year. And 2017 was a very strong year as well. So going back to the current market, we continue to see these shakeouts. Again, ironically, before this past presidential election, there was some fear, uncertainty. We started to drop right before November of 2020, and then we just took off. and then ran higher. And then again, after a nice move here, it was nice to see sideways. And then you really can't see that. But again, intraday this past Wednesday and Thursday were some nice shakeouts. Now, some people, again, might say, well, I don't like it, and it's not really nice when I get tossed around in the markets. And that's why, besides getting a strong entry point, I'm also stressing use smaller positions and give your stocks a little bit of room for people who are maybe newer traders or maybe have high stress levels or anxiety or can't deal with some of the volatility. I'm trying to promote calm trading. I'm trying to encourage confidence and build strength in the members. So what I'm saying is take a smaller position and build that muscle to deal with some of this volatility so that you can eventually build that confidence and work with larger positions. So let's move on to index review.